Here at the International Organization of Securities Commissions headquarters in Madrid, regulators from across the world have converged to map out a new strategy to deal with the burgeoning investigation into the corruption of LIBOR and associated benchmarks and broader questions of currency manipulation in the forex markets. The extent of the misconduct uncovered is both shocking and highly disturbing. It suggests that a cartel has been operating at the highest echelons of global finance.
I think the collusion one is the elephant in the room at the moment, to be honest with you. Yeah. But I think it's only just starting to emerge that there is collusion issues here.
And can we rely then on the stated willingness of major financial institutions that they are recognizing the need to change? Can we just rely on self-certification, or does there have to be more?
Look, I think, no, I think you've got to do more than that. I think one of the things I think is a good idea is to do stakeholder surveys, because, you know, I think, for example, coming and talking to the regulators as part of a stakeholder survey to see what they think is a damn good idea, to see what they think is your culture. Because I'm sure that, for example, you know, some of the people that we regulate, I'd probably give a 4 out of 10, and others I'd give an 8 out of 10. And the one who has 4 out of 10 probably thinks they do a good job.
And to what extent then can one make that information public in terms of your rating of somebody's risk profile as 4 rather than 8?
That is actually quite a difficult one. I guess, you know, that if I would say that again, it depends on companies, but, you know, if I was running a company, you know, we publish our stakeholder survey at ASIC, all right? It goes online, you know, warts and all. Here's what people think of us. But, you know, I think it's probably a healthy thing, actually, to actually publish it and go, well, here's what our customers think of us, here's what our regulators think of us. That's not a bad accountability and transparency mechanism, frankly.
Right now, the global financial system and its regulators, or its regulatory bodies, have 3 tools in which to ensure implementation of our principles. The first one is color diagrams, the second one is peer pressure, and the third one is prayer, and prayer is probably the strongest of the 3. We have no binding institutions, we have no binding dispute settlement system like the WTO, and the problem today is just about manageable, because we have really 2 big jurisdictions, the EU and the US. Everybody else is caught between those 2 big institutions, but in 10 or 20 years' time, we're going to have many, many more big capital markets. So what is everybody going to do? Just apply the rules as they see fit? Because that is a recipe for fragmentation.
I think financial institutions were getting used to the idea that there was a price to pay in terms of additional capital charges, etc., which is a financial cost of doing business. And they were relatively content with complaining about it, but also getting used to it and reconfiguring their businesses around that. And it wasn't necessarily easy, but nevertheless it was livable with. The thing that changed, the real game changer, was effectively the conduct scandals, pure conduct scandals in 2012, which the most significant of which was LIBOR. Because that's when the focus changed to what's really going on. Yes, we have the safety nets, but what's really going on within financial institutions.
And is that when regulators woke up?
I think that's largely true. And you can see even from, we're sitting in IOSCO headquarters at the moment, you can see even from IOSCO's perspective, I think and its members did a heck of a lot of work as a result of that to come up with things like the benchmark reform and such like. So I think, yes, I think that's when regulators did wake up. But there's a long journey, because this trust deficit is something which now informs the entire relationship between many financial sector institutions.
Well, it's very hard to have any trust in the operation of safety nets if in actual fact what you're actually protecting is protecting a cartel.
Yes, or you're protecting effectively by diverting attention to the safety net. You're protecting or even acknowledging that financial institutions have changed so much within 25 years that the idea, which seems very quaint and old-fashioned these days, that your major asset in a financial institution is reputation, is now no longer the case. And right now what you're dealing with is a continued problem around, again, what has been labelled trust, but it's around short-term versus long-term, effectively.
But if, in actual fact, it is a cartel, is that global agenda that we've seen, which has been, people have laboured on for years, right? Ultimately, has it been based on a false assumption?
Possibly. And there's an aspect of this which I think is really important, which is when you're dealing with financial services, the subject matter is deeply obscure, even for regulators. We struggle to understand, putting it in simple terms, what's going on. Now, if we struggle to understand what's going on within a single financial institution, trying to understand what's going on as between institutions, recognizing that the big actors in the financial world are actually relatively few. And we also have this perverse thing happening, which is that the safety nets that have been put in place have favored the growth of large institutions. They get even bigger. So even bigger institutions that should not fail, or there's a fear about them failing. So you end up with something that looks a little bit like the sort of ecology which is conducive to anti-competitive conduct. It must do, if you basically have a regulatory system that favours the large and favours the few.
And is there the political will, do you think, to actually address the elephant in the room?
No.
And why is that?
Because I think if you address the elephants in rooms, firstly, once you've unveiled them, you've decided it's there, are usually too heavy to move. And if you try to move them, you're going to break lots of things. So the idea of really moving past the orthodoxies post-crisis, and there are quite a few orthodoxies, incidentally, in place at the moment. There are orthodoxies about too big to fail. There are orthodoxies as to how to deal with that, as if it's some sort of free lunch, with bail-in and all these sort of other sort of techniques. Ultimately, it's only a question of who pays in practice. It's never free. It's a question of who pays, and that really hasn't been, I think, closely examined. But if you really look at what's happening, we're deferring a problem. We're deferring a problem about debt, we're deferring a problem about credit, and we're deferring a problem about the fact that financial institutions and intermediaries have transformed their businesses to such an extent in a political environment that has encouraged that it's very hard to pull it all back from the brink. I mean, just look at asset managers and the way in which they're effectively, or many of them, divorced from and not interested in because there's no incentive to be in corporate governance. So I don't think there's the political will to really tackle it head on, no.
Now here's the challenge with market manipulation. There's a lot of smoke-filled rooms in the world. There are a lot of places in which participants can get together and decide to agree, to conspire, to collude. And obviously that kind of collusion can reduce the integrity of a particular benchmark, for an example. So regulators and governments have attempted over this past period to put in place a system to try and reduce not only the market manipulation, but to enhance the integrity of those benchmarks. And you know very well what IOSCO has achieved in that area in producing an extremely worthwhile paper on benchmarks, and I think is being relied on to a great extent globally. Bottom line is this though, manipulation, that's a difficult area. That goes to integrity, that goes to human behavior, that goes to the ability of securities regulators to be able to reduce the opportunity for human behavior to not act in a corrupt manner. And I can tell you, that's a challenge that we've had for, through eternity. And regulation can only go so far to deal with that issue, but it's our responsibility to at least try and address it.
So let's talk about the LIBOR scandal and associated manipulation scandals. Do you think, has the issue been dealt with, or is there more to come?
I'd like to be able to say the issue has been dealt with, because clearly what happened in LIBOR was around the 2008 vintage, where there were lots of bad things happening in markets. But the truth is, our current investigations relate to recent activities in the last 2 years. So they relate to things that, frankly, people should have known better, having seen what's happened with LIBOR, but actually the practices are still present. And that's a disappointment, and it's unfortunate, but we'll flush those out as well.
Disappointment, unfortunate. People might think that's an inappropriate response, or not a response which is sufficient given the severity of the crisis.
The difficulty, frankly, is a lot of the activity that we're seeing now is not in what's traditionally been a regulated space. So all of us, every jurisdiction has a legal structure it has to work within, and we have a legal structure we have to work within. That dictates what is within our power to oversee, and some things are not within our power. And so in a sense, we rely therefore on the banks to oversee the non-regulated part in the same way that they would oversee the regulated part. And so the disappointment is that, well, they've just not done that, which is why we've had to go in and take quite strong action.
Now, they haven't done that because they're unwilling to do it, or they're incapable of doing it. Is it a consequence of very complex organisations, that these organisations are too complex for anybody to know what's going on?
In reality, I think it's all of those. Obviously, if people are unwilling to do it, then we take a really tough line with those. Very often, and it's a bandwidth question. There's a lot of change that we're working through at the moment, and within, particularly in the trading rooms of most investment banks, there are subcultures that exist, and that subculture is different whether you're in the credit derivatives desk, or whether you're in the spot forex desk or the commodities desk. But all of those subcultures have traits which have been developed over a number of years, sometimes decades, which under today's microscope just don't stand scrutiny. And all of them need to be addressed. And I guess the issue is how quickly you get around to addressing all of those subcultures.
It goes back to people, meaning you're greedy, your people are greedy, and also cultural reasons. It's normal, it's practice, and like many other people, bankers live together, like lawyers do, and they have a sort of internal culture which is different.
And so is there a responsibility then for regulators to attempt explicitly to regulate culture, to change that culture?
Well, we've tried, but with tools which are probably adequate to formally regulate it, meaning giving people the obligation to explain what they do, how they do it, and why they do it. But to basically change their mind, I mean, just can't do it. So you can put into place mechanisms which may reduce the temptation to not to cheat, but to get more, or to go outside the ethical and moral rules.
So ultimately then, what you're suggesting is perhaps if we think that formal rules will be enough, you're suggesting that formal rules simply won't be enough, they'll be transacted around.
They're not enough, I agree. They'll be transacted around. What you can do as supervisor, because I mean, we do a few rules, but that's not the main thing you can do. Then you have to be more intrusive in your supervision, meaning you have to go on or send people in, for example, audit firms, to check what is really done. It's difficult. You have then to be critical to the answers you receive and to discuss it with people. And we're training as supervisors our people to do that, and not to be just satisfied by the answers they get.
And do the regulators themselves have to change their cultural underpinnings?
Oh, I think so too. I mean, we've to be more conscious of what we do, and to be conscious of what our strategy is.
There is this big discussion about risk management and how the banks and non-banks also have to change their mentality in terms of creating and enhancing the risk management culture. Because at the end of the day, this type of thing comes up when you don't have the right risk framework in place.
And it also happens if you've got an emaciated conception of what corporate responsibility is.
Exactly. Which is also a result of not having the right risk management framework, right? Because if you have the right risk management framework, one of the things that you have to ensure is that you have the right corporate responsibility and transparency and the right levels of accountability in the marketplace. So that's why I strongly believe that we have to work very hard in spreading a risk management culture from a proactive point of view, and in both for the banks and also for the non-banks.
The market works, but it's a matter of how you put the right nudges in place to make sure the market achieves the outcomes that you want it to achieve.
But for you to achieve those outcomes, you have to clearly define purpose.
Correct.
Okay, so what ultimately could or should the purpose of the capital markets be?
Right, well, I think the capital markets is there to serve the real economy. So basically, and I think we don't ask enough often about why financial regulation exists. Well, my view about the why it exists in capital markets is to enable basically capital to be formed by accessing investors, and so that issuers who want to access capital can access it. That's what markets are about, right? It's having end investors and end issuers. And then in the middle are the gatekeepers who facilitate the system. But basically, they don't have jobs if the people on either side here are not providing money and then accessing the capital market. So if this doesn't work, then the system doesn't work, and therefore what we don't have is capital to fund economic growth, and then that ends up with effects on living standards, etc. So it's very critical what we do. At the end of the day, it's about basically the well-being of countries in terms of actually funding their economies.
So that suggests then that market participants have duties and responsibilities as well as rights.
Well, I wouldn't put it like that. What I'd say is that they won't have jobs if the markets don't operate properly. So they actually have an inbuilt economic interest in making sure that those investors and those issuers feel confident to participate in that market.